January 2019 marked a quiet but decisive inflection point in the global energy system. That was the year when multiple national laboratories, including facilities in South Korea, Japan, and Germany, independently confirmed that solid-state lithium cells had crossed from theoretical viability into repeatable laboratory performance. At the time, markets barely reacted. Lithium prices fluctuated. Nickel futures moved. Silver remained classified as a secondary industrial input, largely ignored. The assumption embedded across financial models was simple. Batteries evolve incrementally, materials substitute smoothly, and supply chains adapt without rupture. That assumption, repeated often enough, became accepted as structural truth. History suggests it rarely is. What most observers overlooked was not the headline metric of energy density or charging speed, but a quieter mechanism inside the cell itself. For 3 decades, the lithium-ion battery had been constrained by dendrite formation, a microscopic process with macroscopic consequences. Liquid electrolytes allowed lithium ions to accumulate unevenly, forming needle-like structures that degraded performance and increased fire risk. Every limitation in charging speed, every winter range penalty, every thermal management system traced back to that structural weakness. Entire industries learned to work around it rather than solve it. The hidden shift occurred when researchers stopped trying to control dendrites indirectly and instead redesigned the anode interface itself. This pattern is not new. In the late 19th century, the global electrification boom did not hinge on the invention of the light bulb, but on the adoption of copper as a standardized conductor. Prior to that, iron and mixed alloys constrained grid expansion. Once copper became structurally embedded, demand accelerated faster than mining capacity could respond, triggering price spikes, cartel behavior, and long-term supply contracts that reshaped colonial trade routes. A similar dynamic unfolded in the 1970s with palladium, when emissions regulations quietly transformed it from a niche metal into a strategic automotive input. Prices did not move immediately. They adjusted only after substitution proved impossible. By 2020, Samsung SDI and several peer firms had published peer-reviewed data confirming that a silver-carbon nanocomposite layer could stabilize lithium deposition at the anode. Silver was not acting as a passive conductor. It functioned as an active host, redistributing lithium ions evenly across the interface and suppressing dendrite growth at high current densities. This enabled solid electrolytes to operate safely under conditions that would destabilize conventional cells. The chemistry was explicit. The quantities were measurable. Yet financial models continued to treat silver usage as marginal, extrapolating from historical averages rather than from new functional roles. Systems tend to fail at transition points because institutions model continuity, not discontinuity. In the early 2000s, semiconductor manufacturers underestimated the demand impact of copper interconnects replacing aluminum. Fabrication plants were delayed. Input costs surged. The transition proceeded anyway because performance gains were non-negotiable. In each case, engineers understood the constraint years before markets adjusted. The same sequence is visible here. First comes laboratory validation, then pilot lines, then procurement contracts. Only later does price discovery occur, often violently, when inventories prove insufficient. Global silver supply has been structurally flat for more than a decade, averaging roughly 830 million ounces annually. Recycling contributes marginally, but cannot scale rapidly. Known reserves are geographically concentrated, capital-intensive, and slow to develop. At the same time, baseline demand from electronics, photovoltaics, and traditional automotive systems has remained resilient. Even without new battery architectures, the market has operated in deficit conditions. Introducing a technology that embeds silver as an active battery material does not add linear demand. It introduces a step change. Historical precedent suggests that such step changes are rarely absorbed smoothly. When catalytic converters became mandatory in the United States in 1975, platinum group metal demand surged faster than mining output. Prices rose by an order of magnitude within a decade. Substitution efforts failed because performance and regulatory compliance left no margin for compromise. Automakers adapted not by eliminating the metal, but by securing supply at almost any cost. The same structural incentives now apply to energy storage. Safety, cycle life, and fast charging are not optional features. They are prerequisites for mass adoption. By the mid-2020s, solid-state batteries are scheduled to move from pilot production to limited commercial deployment. Even conservative adoption scenarios imply millions of vehicles annually using cells that require materially higher silver inputs per unit than legacy designs. Unlike previous applications, this silver cannot be easily thrifted without reintroducing failure modes the technology was designed to eliminate. The constraint is chemical, not economic. That distinction matters. Markets can adjust to high prices. They cannot negotiate with physics. This is where part 1 ends, not with a price forecast or a speculative claim, but with a structural imbalance already visible in procurement behavior, patent filings, and capital allocation. The system has not yet repriced the input because it has not yet been forced to. That forcing function arrives only when scale meets scarcity, a sequence that history shows unfolds with remarkable consistency. The second phase of this pattern typically begins with institutional denial. In the early stages of the oil shocks of the 1970s, consuming nations assumed that efficiency gains and alternative suppliers would neutralize OPEC's leverage. The models assumed elasticity that did not exist in the short term. When reality diverged from projections, the adjustment was abrupt and systemic. Energy prices restructured inflation, geopolitics, and industrial policy for a generation. What mattered was not intent or mismanagement, but the lag between structural change and institutional response. In the current context, automakers and battery manufacturers operate on thin margins and long planning cycles. A material that shifts from grams to hundreds of grams per vehicle moves from background noise to a dominant cost driver. At prevailing prices, silver embedded at scale becomes one of the most expensive single inputs in a battery pack. This creates an incentive to delay adoption, but delay carries its own cost. Without solid-state performance, fast-charging infrastructure underperforms, range expectations fall short, and regulatory targets become harder to meet. The system is caught between incompatible constraints. Financial markets, meanwhile, rely on backward-looking data. Commodity analysts project demand growth based on historical usage categories, not on functional reclassification. Silver remains modeled as an industrial adjunct rather than as an energy material. Similar misclassifications preceded previous supply shocks. Uranium in the early nuclear era, rare earth elements during the smartphone boom, and palladium during emissions tightening all followed the same arc. The mispricing persisted until physical shortages forced a reassessment. There remains a narrow window for mitigation. Recycling technologies could improve. Alternative anode chemistries might mature. Mining investment could accelerate if price signals become credible early enough. But these adjustments require lead times measured in years, not quarters. The transition to solid-state storage is moving on an engineering timetable, not a financial one. Those timetables rarely align. What history teaches is not that collapse is inevitable, but that transitions governed by material constraints unfold according to rules that institutions consistently underestimate. The belief that this time is different usually rests on faith in substitution, efficiency, or coordination that has not yet been demonstrated. Occasionally, reform arrives in time. More often, systems adjust only after stress reveals their hidden dependencies. As solid-state batteries move from laboratories into factories, silver's role is no longer optional or symbolic. It is structural. Whether markets recognize that before inventories are drawn down is uncertain. What is clear is that the underlying mechanism is already in motion, indifferent to narratives, forecasts, or policy preferences. History suggests that once such mechanisms engage, outcomes follow not intentions, but constraints.